Let's talk about fundamental analysis. It sounds complicated, but it's really just about figuring out what a company is actually worth. Not what the stock market says it's worth, but a reasoned estimate of its true value. This is crucial for any investor, especially here in the US where the stock market is a huge part of many people's financial lives. So why bother with fundamental analysis? Well, the stock market can be emotional. Prices go up and down based on hype, fear, and short-term news. This creates opportunities. If a stock price falls below what you calculate its true value to be, it might be a good time to buy. Conversely, if a stock is trading way above its estimated value, it might be time to sell. It's about making informed decisions, not just following the herd. It's the bedrock of value investing, popularized by legends like Warren Buffett. Let's break down how it works. Fundamental analysis centers around examining a company's financial health. Think of it like giving a company a thorough checkup. We'll look at things like revenue, earnings, assets, and debts. There are really three main areas we focus on: income statements, balance sheets, and cash flow statements. Let's start with the income statement. This tells you how much money a company made, its revenue, and how much it profited after subtracting all its expenses. A simple example, let's say TechCo had $10 million in revenue and $7 million in expenses. That leaves a net income or profit of $3 million. That sounds good, right? But we need to look at this over time. Is revenue growing? Are expenses under control? A single year's income statement doesn't tell the whole story. Next, we have the balance sheet. This is like a snapshot of what a company owns, its assets, and what it owes, its liabilities, at a specific point in time. Assets include things like cash, buildings, and equipment. Liabilities are things like loans and accounts payable. The difference between assets and liabilities is called equity. Equity represents the owner's stake in the company. A healthy balance sheet shows a company with more assets than liabilities and a growing equity base. Imagine retail giant has $50 million in assets and $20 million in liabilities. That means they have $30 million in equity. Finally, the cash flow statement. This tracks the actual movement of cash into and out of a company. It's different from the income statement because it accounts for things like depreciation, which is a non-cash expense. A company can be profitable on paper but still run out of cash. Positive cash flow is crucial for a company's survival and growth. Think of ServiceBro consistently generating positive cash flow from its operations, even if its net income fluctuates. So how do we use this information to actually value a company? There are several methods, but we'll focus on two simple ones: price to earnings, P/E ratio, and discounted cash flow, DCF. The P/E ratio is easy to understand. It compares a company's stock price to its earnings per share. Let's say Innovate Corp has a stock price of $50 and earnings per share of $5. Its P/E ratio is 10. Generally, a lower P/E ratio suggests a stock might be undervalued, while a higher P/E ratio suggests it might be overvalued. However, you need to compare it to the industry average and the company's own historical P/E ratio. The discounted cash flow method is a bit more complex. It involves estimating the future cash flows a company will generate and then discounting them back to their present value. This is based on the idea that money today is worth more than money tomorrow due to inflation and the potential to earn a return on investment. It's essentially calculating what all those future cash flows are worth right now. This requires making assumptions about future growth rates, discount rates, and terminal value, which is why it's more complex, but it's also a more robust valuation method. Now, let's say we estimate that Green Energy Co. will generate $1 million in free cash flow each year for the next 5 years, and let's assume a discount rate of 10%. After calculating the present value of each year's cash flow and adding them up, along with the present value of the terminal value, we might arrive at a total present value of $4 million. If the company's market capitalization is currently $3 million, it might be undervalued. It's important to remember that fundamental analysis isn't perfect. It relies on estimates and assumptions, and the future is always uncertain, but it provides a solid framework for making informed investment decisions. Don't just look at the stock price. Dig deeper, understand the company, assess its financial health, and then make a reasoned judgment about its true value. You'll also want to analyze the industry it operates in, its competitive landscape, and the quality of its management team. In summary, fundamental analysis is the process of evaluating a company's intrinsic value by examining its financial statements, industry position, and future prospects. It helps investors identify undervalued or overvalued stocks, leading to potentially better investment returns. It involves analyzing income statements, balance sheets, and cash flow statements, and utilizing valuation methods like the P/E ratio and discounted cash flow analysis. Remember, it's not a crystal ball, but a powerful tool for informed investing. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.